All right, Michael, you are the real estate expert. I am not. And I saw something on your channel the other day and I was like, wow, he's got to break that one down for me. So you had the legend Brandon Turner of Bigger Pockets on, and he was talking about real estate syndication and how it's getting worked right now. And so one of the things that actually drew me back was he said, I'm involved in 3 syndications outside of his own business. 2 of them he thinks are going to go to 0. And one of them he's going to get 50% back on. Yeah. I'm no expert, but I don't know if real estate prices go from wherever they are to 0. So how do you end up with 0 in a syndication deal?
Yeah, so let's break it down. And really the missing piece, again, you're not a real estate guy, is what really goes to 0 is the equity, right? So in a typical deal, and again, these are large apartment deals in many cases, let's just use some examples. And I just did some quick math. So just for folks that don't understand what happened the last couple of years is cap rates have been collapsed. So I've told plenty of examples in my market where the quantity or quality of the assets I was buying usually trades at about an 8.5 cap.
Yep.
They got as low as 5.5. And I've been in the space for 25 years, and that's crazy. So again, when you do mean reversion, you go back from 5.5 to 8.5, you have a big loss. But let's give people some math. Let's say there was a building that produced $100,000 NOI, net operating income. The math calculation is pretty simple, right? You take the NOI and you divide by the cap rate. So I did it at 4% for easy math. Bingo, bango, that building's worth $2.5 million. If the cap rate just goes from 4 to 6, and NOI stays the same, which in this environment is not a certainty given prices and rent and all of that, the value goes to 1.6. So the value collapses $900,000. Now, how does it go to 0?
That still is not 0. What's going on? What am I missing?
So the problem is how these properties were financed. Okay. That's where the gotcha is. So a lot of these properties, when they were bought for $2.5 million in this example, had to take out interest only, short-term debt, and they took it out at 75, let's say 70%, for example. So on a $2.5 million building, they had to raise $750,000. And then they got a loan for $1.75 million.
Right.
Okay. So when they have to refi, because they don't have a choice, right, at the end of the 2 or 3 year term, the building is suddenly worth 1.6. The loan is 1.7.
Got it.
Equity is gone. So they only have a couple of choices. So again, the building's worth 1.6. They can do a refi, but again, it's 70%. So I don't know what that is, 3, 4. So they got to raise $600,000. It's called a capital call.
Yep.
The new loan will be roughly 1.2.
Yep.
Which is not very likely in an environment where you think your equity is 0, right? Very unlikely you're going to, bring it back. Right. They could be a forced seller, which will then wipe out all of the equity, i.e. go to 0, and the bank will have to short sale it because again, the value is 1.6 on a 1.7 loan. Or the bank just extends and pretends.
Yep.
And this is exactly what's happening to a lot of LPs. A lot of LPs got in at the wrong time. It's a classic investor trap. Buy high, sell low. And, 2 of Brandon's investments are going to 0 because the equity's wiped out. And it's really a tragic affair. And it's all because of the debt structure. I think what is most comical for me kind of watching this is the commercial space essentially repeated exactly what we did in 2006 in residential. We got short-term paper. We got a lot of new operators and investors who didn't really know what they were doing. We had unrealistic expectations. So I've been an accredited investor for 15 years. I've been seeing syndication deals for 15 years. And all the deals that I was seeing in 21, 22, they just had unrealistic expectations. 5% rent growth, that doesn't happen, right? It might happen in a pandemic, but it's not something you can bet on, right? They were thinking cap rates would go from 4 to 3.5. That didn't happen. And there's just going to be millions and millions of dollars completely lost, vaporized, poof, gone. So that's how it happens.
Let me fire a question at you here. 2 questions. The first one being, and this is not throwing any jabs at Brandon, who again, he is a legend in the space. How does someone like that get caught up in an event like this? And again, that's not a shot. I'm trying to understand this a little better as someone who is, incredibly knowledgeable in the space.
Well, I mean, if we just step back and realize what happened is we had a lot of new entrants of syndicators in 2020 and 2021, and they caught the wave perfectly, right? A lot of these syndicators were coming in and doing what's called value add deals.
Yeah.
And initially in 2020, the value add deals were like 2 or 3 year runways. But what they found is all they had to do was remodel like 10% of the units, and then they could resell it for $1 gazillion in profit, because they were catching the cap rates on the downside, right? They bought it at 7, sold at 5.5. They bought at 6, sold at 4.5. And they were churning out these massive returns in a year or less. And anytime you know this in stocks, it's the .com thing all over again. You throw a .com thing on it, everybody wins for the moment. Then people start thinking they're smarter than Warren Buffett. I'm looking at myself for that. And we all lose in the blow up. And that's exactly what's happening.
So where are we at in the cycle now? Loaded question.
No, it's this is an important question. I think most people miss it. Class A, which is the creme de la creme. It's the Apples, it's the Amazons, right? It's the Mag 7 of stocks, is starting to retrade, but retrade at a 25% discount. So what you're seeing is a lot of the equity is being wiped out, but not all of it, right? Because a lot of these loans were 70%. So we're already seeing Class A take massive hits. What's not trading, and why Brandon Turner was cautious about his, is Class B and Class C. That is still suffering price discovery. The problem is that I've been through this show before. If Class A has a 25% known discount,
what B and C do look like?
B and C got to be 35, 40, 50%. Yeah. Now we're talking equity wipeouts. We're talking banking losses. And if these banks have mark-to-markets on these at par, we could have a banking crisis. That's why the problem with the 10-year going up to 5 or 6% would just destroy banking, because you'd have to mark to market. It's Silicon Valley Bank all over again when the 10-year exploded. It's just in a different asset. So
are you getting to a point where you're starting to lick your chops yet?
Oh, I am excited. Yeah, I've got I have a whole bunch of assets. Again, dude, I could potentially repeat the magic of my first book, One Rental at a Time. And if you don't know what that is, I had 8 houses that were entry-level housings that I sold for peak pricing, and I moved all of that equity into distressed apartments. I'm on the cusp of doing that again. I think we're 6 months away to potentially 18 months away. But Class B and Class C cannot survive extend and pretend. And heaven forbid we get a 10-year at 5%. If we go there for some reason, the bloodbath is going to be amazing for me and suck for many.
So let me understand this correctly. You have single-family housing residentially. Their prices have held up well, still firm. You're going to fire sale. You're not going to fire sale. You're going to sell those onto the market at good prices.
Correct.
And you are going to buy the fire sale that's happening in multifamily on the other end.
Just like I did in 08, 09.
So let me ask you another question. Why is there such a discrepancy? Is it just the bad financing? Is it just the craze of cap rates crashing so much? Why has residential held up so well against multifamily now that is going to experience the pain that it's going to experience?
It's once again the financing. People don't get this. It's often the financing that blows deals up, right? We know that in the residential landscape, I don't know what the exact numbers are, but something like 80% of loans are fixed below 5%. 40% of residential homes are owned free and clear. It's just not even the same game, right?
Yeah. 5-year term generally that then they mark to market, and they were booked in 2019 at.
Well, it's even worse. They got so stupid they were doing 3 years.
Oh boy.
Right. Yeah. They kept going shorter and shorter. And by the way, IO, right? Interest only. So there was no principal pay down. Right. So they just kept taking riskier and riskier loan types, rejiggering these Excel spreadsheets to create some fake return.
Look at this magic.
Yeah. Woo! And all they're going to do is burn millions and millions of dollars. There will be LPs, i.e. Brandon is an LP in 3 deals in this example, that will never come back. I'm not saying Brandon will come back, but I'm saying the LPs that rushed in at the moment, just like me keep rushing into .coms. Once I got smacked by 80%, I didn't come back for 2 decades.
Right. Well, I will say this. I don't know Brandon. You do. I have seen Brandon in several places. This is no hit upon Brandon by any stretch of the
No,
imagination by
no.
either one of us. I was just
No.
trying to understand how
Yeah.
the process works, and you explained that beautifully. You're that's why you are who you are. You're the master of real estate.
There you go.
Thank
I
you so much
appreciate
for
that.
educating me.
No, I appreciate the questions. This is it's good to know the help goes both ways. You help me all the time, so I'm glad to provide some advice or color commentary. Where can people find you?
Yeah, find us at LifeGoal Investments. We're on both Instagram and on TikTok. We're more of the markets, public markets feel, and Michael's certainly more of the real estate expert.
Yeah, folks, if you're not following LifeGoal Investments on Instagram, you are missing out on a true treasure. Thanks,
Thank
buddy.
you so much.